In 2011, the prize was endowed by a generous gift to Wharton from Bruce and Ken. It is given every 2 years to recognize outstanding quantitative research that has contributed to a particular innovation in the practice of finance. It is accompanied by an $80,000 cash award and a sterling silver medal, which is the emblem of the prize and its recognition of groundbreaking research. We're delighted to have with us today Pete Kyle in person to accept the prize for his research on market microstructure. This work focused on the effects of market structure and the behavior of market participants on the efficiency and liquidity of the markets. I will now turn it over to Chris for more discussion of the prize-winning innovation.
Great, thanks, Craig. Throughout the program today, as you obviously well know, we've explored the impact of Pete's prize-winning work. His 1985 econometric paper from a high level developed a model of informed trading that has been widely used in both academic research and in a plethora of practical applications, such as the development of algorithmic trading strategies and market-making strategies. By showing that they can help increase liquidity and reduce transactions costs, but may also face risks if they hold large positions in a particular security, Pete's work also helps shed light on the role of market makers in financial markets. His research highlights the importance of transparency, liquidity, and market structure in promoting efficient price discovery and reducing transactions cost. This groundbreaking work by Pete added significantly in multiple ways to our understanding of the functioning of financial markets, contributing to the development of more sophisticated trading strategies, risk management techniques and technologies, and market regulations that have helped to promote more efficient and transparent financial markets. Pete was chosen for the prize by a committee of esteemed academics and practitioners. Thank you to Bruce Jacobs for his excellent steering as chair of the committee, and to Andrew Alford, Jonathan Burke, Jennifer Conrad, and Joanne Hill for your valuable contributions as members. I had the pleasure of serving on the committee in an ex officio capacity, and truly, it's an honor to recognize the work of Professor Kyle. Before we hear directly from Pete, I'd like to introduce again Bruce Jacobs and Ken Levy. Please join me in welcoming Bruce and Ken.
Thank you, Chris and Craig, for those kind remarks. Pete Kyle, the son and grandson of cotton merchants, had worked at the Chicago futures market. So he knew that the act of trading itself could move prices. A large buy order could push prices up, a large sale could push them down, and not every trader would get the same price. In a 1971 paper, economist Jack Traynor proposed that informed traders with non-public information, quote, could make their profits from market makers, who in turn make their profits from those who trade without genuinely new information, unquote. The dynamics of trading seem closer to game theory than to the efficient market hypothesis. In Pete's seminal 1985 paper, Continuous Auctions and Insider Trading, he proposed a model to explain trading dynamics when there's information asymmetry along the lines described by Traynor. Pete's model contained 3 types of agents: an informed trader who has specific knowledge about the value of what's being traded, uninformed noise traders who trade randomly, and market makers who facilitate trading. As the process unfolds, trades by noise traders mask those of the informed traders, who adjust order flow so that private information is incorporated into prices gradually. Pete's elegant model became the framework for researching the market impact of trading and remains so today. Pete's insight and expertise has long been in demand in the halls of finance and government. He served on the Brady Commission that examined the causes of the 1987 stock market crash, and he's also served in advisory roles to various government agencies, FINRA, and the NASDAQ. Those of us who manage portfolios, as well as our clients, owe a debt of gratitude to Pete Kyle for shining a light on the inner workings of the trading process, which is so important and yet so little understood.
The Wharton-Jacobs Levy Prize for Quantitative Financial Innovation recognizes outstanding quantitative research that has contributed to an important innovation in the practice of finance. the 2023 Wharton-Jacobs Levy Prize recipient, Albert S. Pete Kyle, is being honored for his groundbreaking work exploring the market impact of trading and its effects on prices and liquidity. Even though it is common for empirical work in finance to assume a frictionless market where transactions costs don't matter, practitioners know that those costs are very real. Before the publication of Pete's paper, Continuous Auctions and Insider Trading in 1985, putting numbers on some of those costs was at best a guess. Pete's paper, known today as Kyle 85, gave us a theoretical foundation for understanding a difficult question. How is the cost of a trade affected by the dynamics of the trade itself? More specifically, Kyle 85 helped us to understand how prices are determined when, as is often the case, some traders have better information than others. Nobel laureate Robert Engel noted that Kyle's seminal work is one of the first papers that explored how private information is revealed by trading. The paper offers a roadmap for informed agents who want to adjust order flow to maximize profits. It also provides a framework for all of us to understand the bid-ask spreads and market liquidity. Kyle 85 gave us Kyle's lambda, a measure of market liquidity and depth. More importantly, Pete's work helped spur a broader interest in the study of market microstructure. This offers practitioners crucial information on the real-world costs of their trading strategies. Given the highly competitive nature of our industry, the importance of minimizing such costs cannot be overstated. When Ken and I established this biennial award in 2011, it was our hope that over time, the recipients would constitute an elite group of scholars and practitioners who have had a transformative impact on finance. Prior award winners are Markowitz, Sharp, Ross, Ball and Brown, Jagadish and Titman, and now Pete Kyle. I believe we are achieving that goal. We are proud to award the 2023 Jacobs Levy Prize for Quantitative Financial Innovation to Albert S. Pete Kyle in recognition of his seminal research on market microstructure. Pete, thank you for your contributions and a hearty congratulations. Please join us for the presentation of the prize medal. Pete, congratulations on winning the Wharton-Jacobs Levy Prize for Quantitative Financial Innovation.
Well, thank you so much. I'm really happy, as about as happy as I can be. Thank you.
Congratulations.
Thank you. Well, thank you so much, and I'm happy to make some remarks. But the conference is the conference on frontiers of research, and my paper was written in 1985, so it would seem that it's pretty far from the frontier. So what am I going to be able to talk about? Well, I'm going to talk about the research that I did in 1985 and how it connects with the research that I'm doing now, which I hope is close to the frontier of finance and is appropriate for the title of this conference. So my plan here is to quickly review my 1985 paper, but Ken already did a better job of reviewing it than probably I'm going to do, and then describe how the ideas in that paper connect with some of my more current research. One is research on market microstructure and variance. There are a couple of papers there with Anna Obazhayeva, a co-author of mine who used to be at the University of Maryland and is now at New Economic School in Moscow, Russia. Another paper that's called Smooth Trading. That's a paper with Anna Obazhayeva and Yajun Wang, who's here, that I'd like to talk about. And then finally, a paper that I call Flow Trading that's with Eric Budish and Peter Crampton and is related to the research on frequent batch auctions that was summarized earlier. It's been talked about earlier today. Okay, so a summary of my 85 paper is we want to show how the depth of the market or market liquidity can emerge from a game theoretic model. It's real simple. It has some adverse selection in it. Also has market power in it. And I think market power might be or strategic trading might be the biggest innovation there. So you have these different types of traders. The liquidity traders, they demand instant execution of their orders. They're very impatient. And you have an informed trader who trades strategically, is very smart, understands what he's doing. And what he winds up doing in equilibrium is to trade gradually. And the effect of that is to smoothly incorporate his information into prices. But as he does that, he maximizes his profit. Risk aversion, which has been a big feature of a lot of models of liquidity, and important for the way a lot of people think about liquidity, is not part of this model. And indeed, I think that risk aversion is not the main thing that's going on with the provision of liquidity. I think the main thing that's going on is the strategic trading to avoid market impact costs in the presence of adverse selection. So the model is very simple, and the optimal strategies are linear. So this is not the notation in the paper. It's a sort of different notation, but the basic idea is there's some fundamental value that an informed trader has learned, perhaps by spending a lot of money developing complicated models or doing a lot of research. And that's a random variable that we assume is normally distributed. And then there's some noise traders that are completely orthogonal or independently distributed who just trade randomly, and they demand liquidity instantaneously. And the informed trader chooses a quantity to trade. He doesn't make that quantity contingent on price in this model for reasons I'll talk about in a second. So he chooses a quantity to trade to maximize his profits, taking into account the fact that he's going to have price impact. And that's the result that results in Q, the quantity he's going to trade. Now, I assume that the market makers are a special category of traders who can make the prices, the quantities they trade, contingent on the price in the market. So they will trade a bigger quantity if the incoming order flow has more price impact. And they also are rational. We assume kind of maybe euphemistically that they are perfectly competitive, driving their profits down to zero. It's easy enough to put some profits in there. You could get the profits from risk aversion. I think more likely you get it from imperfect competition among the market makers. But the key assumption is the market makers can't tell the difference between the informed trader and the noise traders. So think of the noise traders coming in and wanting to buy 10,000 shares, and the informed trader comes in and wants to sell 5,000, net imbalance is plus 5,000. The market makers have to take the other side of that, but they don't know which of those two blocks coming in is the informed block and which is the noise block. So they just essentially are going to behave in a manner that is symmetrical with respect to those two things. And so what happens is that you get an equilibrium that's a game theoretic, a kind of Bayesian Nash equilibrium, if you will, or close to that, in which the informed trader chooses the quantity he's going to trade as a function of this private information, and the market makers choose how much depth or liquidity to offer in the market, and the impatience or the size of the informed trader's trade is governed by a parameter beta, and the price impact of the trade, which is kind of the reciprocal of the market depth or the reciprocal of the liquidity that the market makers are providing, is given by this parameter lambda. And one of the nice little things about this paper that might have made it popular is the equilibrium that you get is so simple. That's that beta is just a ratio of what we call sigma u to sigma f. Sigma u is the standard deviation of this normally distributed noise trading random variable, and sigma f is the standard deviation of the signal or the quantity of information that the informed trader has. So looking at the formula for beta, sigma u divided by sigma f, if there's more noise trading, the informed trader trades a larger quantity, proportionally larger. Noise traders essentially are creating depth that allows them to do that. They're creating liquidity that allows them to do that. And if the sigma f is large, this variance of his signal is large, that means that other people in the market think he's got a lot of information. And so that's going to make the price react more, and that's going to make him trade less. So lambda, this price impact parameter, is the ratio reverse, so it's the reciprocal of the beta essentially, with a 1/2 multiplying it. And so the bigger sigma f is, the standard deviation of the signal that the informed trader has, therefore the more adverse selection there is in the market, the less depth the market makers want to offer, the more impact the informed trades will have and the noise trades will have. And if there's more noise trading, they will offer more market depth in the market. So that's the result of the paper in a nutshell. That's a simple one-period version of the paper. There's a continuous version of the paper that unfolds in continuous time, and the difference is that the noise traders trade as a Brownian motion, and the informed trader, the Brownian motion unfolds over an unspecified period of time. You can call it 0 to t or 0 to 1, but one of the things I want to talk about, does that correspond to a day or a month or a minute? What does it correspond to? But the trading takes place over what you could call a trading day, and the trading of the informed trader winds up being very gradual. He chooses an impatience or a beta that's a function of time, but the gist of the solution is that he chooses that beta so that the price gradually moves from wherever it starts to the price that reveals all of his information at the end of the day. He's not going to leave any information on the table, so to speak. So that's the gist of the paper. One of the facts that Larry Harris referred to in the comments is that lambda, this market depth in the continuous time version of the paper, is a constant. And if it's not a constant, there's some kind of strategy that you could call a manipulation strategy, or maybe it's not. But there's a strategy that the informed trader could carry out to exploit the other traders in the market and kind of keep profit from something, profit essentially from nothing. Another interesting feature of the equilibrium that's due to the competition among the market makers is that prices are not forecastable if you don't have the informed trader signal, because the market makers essentially arbitrage away all of their profits and earn zero return. And finally, the return volatility of the asset winds up being equal to the information that the informed trader has. So volatility represents the revelation of information or unfolding of information through time. Some features of this equilibrium, it captures different roles for different players. We have this rigid distinction between market makers, informed traders, and noise traders. And that I think it was kind of mimicking the structure of the market you saw in the 1980s. But that structure has changed, and so it may not be an appropriate assumption anymore. It's clear that the informed trader makes their profits at the expense of the market makers. In the one period model, the informed trader exercises his strategic market power by incorporating essentially half of his information into prices. And in the continuous version, he strategically exercises his market power essentially by walking up a demand schedule slowly over the whole day, gradually revealing his information into prices. The noise traders continuously, instantaneously demand liquidity. Without smoothing their trading that I'm going to come to, only the market makers can adjust their quantities to prices. And we get this market depth result. Finally, the equilibrium is what looks like today we would call batch auctions. We batch the informed traders and the market makers trading together and force them to trade simultaneously. In today's world, that's a discussion about how the market should actually function. At the time, I would say it was more of an analytical tool to make sure that the equilibrium was very simplistic. Okay, I'm going to step back. It's really nice to be receiving this award, but then I think it's a good occasion to step back and say, like, what needs to be updated about this paper, and how can we bring it to the frontiers of finance today? And so let me give a critique of the paper, and then also see how this critique relates to my current research. So number one, the distinction between market makers and other traders used to be more important than it is today. Now we have more like all-to-all platforms in the equity market, so asset managers can almost compete with the market makers better and provide liquidity to one another more easily than they could have done, let's say, on NASDAQ in the 1990s. This issue is addressed by the smooth trading research that I've been doing, and also by the invariance research to some extent. Noise traders in my 85 paper, they demand instantaneous liquidity. They're not willing to wait 1 minute. In the continuous version of the paper, if they smooth their trading out over a very short period of time, they would reduce their market impact costs by 50% because they would be able to walk along a demand schedule and lose what an economist would call a triangle of losses, rather than instantaneously dump their shares in the market and lose a rectangle which has twice the area. So why don't they do that? And the answer is they should, and they do, and I'm going to talk about that in the smooth trading paper. Another issue is, how do you apply my 85 paper empirically? And you would think that somehow that standard deviation of noise trading corresponds to trading volume, but in the continuous version of the paper, we have to deal with the fact that in a diffusion, the total variation of the process is infinite, and therefore trading volume would be infinite. How do we map this into a finite, reasonable measure of trading volume? That's addressed by both the smooth trading and the invariance papers. And then there's this time. In my 85 paper, trading takes place over something I like to call a trading day. But how long is this day? Is it 1 day? Is it 1 month? Is it 1 week? Is it 1 minute? And that's what the invariance research that I've been doing is supposed to address, and come up with a concept of like business time. And finally, I said that the market makers in the paper, they're the only ones that can let the price influence the quantity they trade. Nowadays, it's much easier for institutional investors to put an order in the market that allows the institutional investors to instantaneously, essentially, provide liquidity to other traders. So it's easier for them to place these orders, price contingent orders in the market. And the result is that you shouldn't see as much bid-ask bounce in many stocks unless they're forced to have a penny bid-ask spread, as you used to see, because sometimes the high-frequency traders or market makers will be picking off the bid and the offer rather than just buying at the bid and selling at the offer. And then finally, it's not quite clear it's not exactly in the paper, but it's not quite clear to apply this batch auction concept, which seems to be a reasonable concept, to a market in which many assets are traded. So my current research is dealing with that. So let's go, that's my 85 paper and my critique of it. So now let's talk about how some of these things work. And I probably have to spend most of my time on the smooth trading because I've got a limited amount of time here. I won't be able to say too much about the other, I'll spend most of my time on invariance. I won't be able to say too much about smooth trading or flow trading. So the question that we're trying to deal with here is how to map, you can think of it, my 85 paper into an empirical set of empirical predictions that are kind of consistent with my 85 paper, but allow us to understand what trading volume is, which is not very well defined there, and also understand how market depth works and how it's related to volume and volatility. And so what we'll want to do is we'll want to figure out what the parameters sigma v and sigma u kind of correspond to empirically, and how to measure market depth empirically. So the strategy we adopt, I'm not going to really talk about this slide. There are several different approaches here. One's in our econometrica paper. That's what we call invariance principles. But another one is what we call a meta model. That's what I'm going to talk about here. And the idea behind the meta model is to come up with a system of equations that looks really simplistic and actually could describe what's going on in many different models. and because it seems so reasonable. So let me just skip to the equations. But before I get there, let me just mention what's one of the key intuitions behind this invariance research, and it also happens in my 85 paper, and that is for the parameters and the quantities that we're talking about to be integrated into the model in a way that respects the units in which they're measured. So you get a kind of consistency in units of measurement. So for example, that lambda parameter from my 85 paper, it's it's what you multiply the quantity by to get price impact. So that the actual price impact is going to have units of dollars per share. That's going to actually give lambda units of dollars per share squared. The dollar price impact is going to have units of dollars, and that would be lambda times q squared. You could also measure price impact in percentages, like 10 basis points. So it could be 4 cents per share, or $400 for the whole order, or 10 basis points. Lots of different ways of measuring it. Now, in principle, you could have a nonlinear price impact. My 85 paper has linear price impact, so we will think of a linear price impact model here, even though I've got this exponent beta that you see at the bottom of the slide. Okay, so the intuition for all of this invariance idea is that orders come into the market and are shredded into little pieces, or they're executed in little chunks. And the rate at which the orders arrive is their gamma orders per day arriving in the market. And we are going to think about the cost of executing an order as lambda. That's the price impact of trading Q shares, but the price impact cost is kind of lambda times Q squared, Q to the 1 plus beta power. And the expectation of that, C, is the kind of expected cost of executing an order or a bet. Think of it as a meta order in the market. And so for a typical stock that's maybe not that big, we think of these as institutional bets. We're kind of ignoring the retail side of the market here. And a typical stock, maybe in the bottom of the S&P 500, might have about 100 bets a day, which means that each bet is about 1% of the average daily volume that you see in the market. That's kind of the way we think about it. So here's some variables. Price, it's got units of dollars per share. Trading volume, it's got units of shares per day. And returns volatility, well, that's a big one, because variance has units of kind of per day, but that means standard deviation, which is the way we measure volatility, has units of per square root of a day. So day to the 1/2 power. It's very important to remember that. But there's a lot of other variables that are microstructure variables that we would like to measure, and they have all different kinds of units. There's the size of bets. 10,000 shares might be a way to measure the size. Of the rate at which the bets arrive, maybe 100 a day would be typical. There's the execution horizon over which a bet is executed. They're often not executed instantaneously nowadays, but spread out over time, maybe over 1 day. The price change that execution of the bet generates, here we've got it as 4 cents per share. There's this price impact coefficient lambda. It's some small number, like maybe 5 times 10 to the minus 5th power. It's hard to interpret economically. And then there are a couple of others that I'm going to skip for the time being, because I'm going to run out of time. So if you look at the first 4 equations here, we've tried to write down 4 simplistic equations that we think a reasonable model might have, not just my 85 paper, but lots of other models. One is the definition of volume. Well, volume is gamma, number of bets per day, times the expected size of a bet. That's the first equation, just the definition of volume in some sense. The second one has got some content to it, and it's the idea that the arrival of the bets is moving the price, and that is what's generating return volatility, and it's generating it in a way that's consistent with prices following a martingale, just like my 85 paper. So what does that mean? That means that the variance of returns we see should be equal to the number of bets that arrive per day multiplied by the squared return associated with each bet, the kind of the variance associated with each bet. That's equation number 2. And then we've got the price impact of 1 bet, and that says that the squared price change that 1 bet implies is just the price impact of that bet squared, lambda times the expected value accepted squared, so it's a lambda squared times the expected value of the quantity you trade squared. So that's a pretty innocuous equation as well. And then the 4th equation that's not innocuous, but is going to be the invariance assumption. But the cost of a bet is lambda times the expected quantity squared. That's the kind of price impact cost of that bet. Well, it turns out that, let me skip ahead a couple of slides here. It turns out, well, let me not skip it. It turns out that we've got these 4 equations, but if you look at the unknowns, a lot of the unknowns are very hard to measure. So what we do is we assume that certain quantities are invariant. That is, that they're going to be constants across any given stock and kind of constant across time if you adjust for inflation. And the big invariance assumption is that C is going to be constant. We think of it as about $2,000 per stock. It doesn't have to be constant for these equations to make sense, but it helps us empirically. And then we also need to think of the shape of the distribution of the sizes of the bets as being the same across the stocks. Maybe a different mean, but scaled. Think of that as a scaling parameter, and therefore different moment ratios should be the same, and that's what the equations with the m's say. So that, when you add these equations with the m, you get 6 equations, and it turns out that you have 6 parameters that are kind of easy to know, but more importantly, there's 6 parameters that are kind of hard to know, and those are the number of bets that arrive, the price impact, the effect of those price on the effect on the price in the market, and the size moments related to the sizes of the bets. These are all kind of hard things to measure unless you can sort of see bets in the market. And it turns out that we now can think of it as 6 equations and 6 unknowns, where the 6 unknowns are the hard to observe parameters, and so are the hard to observe variables. And we saw for these hard to observe variables in terms of the ones that we can kind of readily measure, like price, volume, volatility, and the invariant parameters, which we'll assume are constant across assets. So to implement an empirical model, we would really merely need to estimate 3 parameters, and then we've got a model that would apply to hundreds or thousands of stocks at the same time once we've got these 3 parameters. Well, it turns out that you can solve these equations. They're log linear, so it's really a linear solution. And it turns out that to help make that solution intuitive, you can define what we call an illiquidity measure, 1 over L, or a liquidity measure L. And what that is, the 1 over L, is the expected cost, kind of in basis points or a fraction of the value traded, of executing a typical bet. It might be 30, 40 basis points for institutional size bets and not so liquid stocks. And it turns out that 1 over L can be expressed as a function of things that are either invariant, that's the C and the M, or things that we can readily observe, or at least estimate pretty accurately, and that's the returns variance, or the standard deviation, the volatility sigma squared that you see in the numerator, and the PV, which is just dollar volume per day, that you see in the denominator. Furthermore, if you look at the units in which the numerator and the denominator quantities are measured, the units, they're both dollars per day, and so the units cancel out, and this 1 over L measure is dimensionless, which is exactly what you want in a measure of trading costs when you want to say that trading costs are 30 basis points. That's a dimensionless quantity. It's 30 times 10 to the minus 4. So in terms of L, you get formulas for what all these things are, including the lambda of my 85 paper, which is the 3rd equation you see here. And if beta is 1, what it says is that the lambda of my 85 paper is just a constant times p squared in the numerator, which gets the units to be kind of correct. And then in the denominator, you have L, this liquidity variable squared, and you also have this invariant constant C. So that basically gives you a way of implementing my 85 paper empirically, and all you have to do is estimate the constant C and the parameters M. The parameters M, and so we do that in one of our papers. So, as I said, market microstructure invariance is the hypothesis that the C and these moment ratios are constant. And what we get from our preliminary calibration is that C is about $2,000. And the M is a very small number. If you were in a market where the size of the bets were plus or minus, let's say 10,000 shares, kind of a binary variable like that, these M's would be 1. We think that the quantities traded have a log normal distribution with a fairly gigantic variance, so the M is a lot less than 1. And anyway, that's what we get. So our previous research shows that these invariant parameters are maybe do kind of work. This is a plot of bid-ask spreads on stocks in the S&P 500, And on the left-hand axis, you see the number of trades, which is gamma, should be proportional to L squared. And on the horizontal axis, you see L in logs. And the red line represents the slope that it's supposed to have. And you can see that that slope is just about right. You get a very similar plot for the Russian market, where incidentally it's maybe a little bit better. And in the Russian market, they change the tick size a lot, so you don't get stocks trapped at 1 penny bid-ask spreads. It's very consistent there. And then we looked at actual quantities, because our model not only makes predictions about the depth of the market lambda, but it makes predictions about the sizes of the bets. If you look at the equation on the top here, you'll see that the size of the bets are proportional to L, C times L. And so we asked the question, are bets proportional to C times L? And in a data set of portfolio transitions of individual stocks executed by a prominent transition manager, we find that the sizes of the bets in the individual stocks match. It's of course very random because they're log normal distribution with a big variance, but the slope of how they vary with volume and volatility is almost exactly what the theory, the invariance hypothesis that sees a constant predicts. Okay, and the distribution of the size of the orders actually does look like a log normal, as we also said. So and the trading costs, they don't exactly look linear, but they calibrate very well with the way the model says they should. The red dot should be one-dimensional, and the black line would correspond to beta equals 1. The red line corresponds to beta equals 0. And beta equals a half. But we think the model calibrates pretty well to either a linear or square root model. Looks better here for square root, and we think there are reasons for that, and it's something that takes us beyond the discussion right now. So there's a question here. So what we've done is we've created, and I've only got a couple of minutes left, so I'm not going to get to the other things. You can ask questions about it. Where's the adverse selection? And the answer is there is no adverse selection in this meta model. It's just a model of trading pieces of paper. Many market makers in the market don't know much about the stocks that they trade. They don't care about fundamentals or information. They only care about prices and quantities, and that's the currency that they deal with. But you can add the adverse selection or the information to this, and when you do, you get you get some interesting things. Let me just mention. In terms of my 85 paper, these equations simplify because the beta is 1, the price impact is linear. And when you solve them with the linear version, you get to map the sigma f, the standard deviation of the informed trader's information, and the standard deviation of the noise trading directly into the observable or easily estimated parameters from this meta model. And you can see that the sigma f is related not to the standard deviation of the price over a day or a month or a minute. It's the standard deviation of the price change over 2 bets arriving. And essentially it's 2 bets because you've got the informed trader's bet arriving and you've got the noise trader's bets arriving, and they both move price, and the market makers don't know which is which. So that's what you get. And the noise trading is sigma u turns out to also be interesting. So that's the amount of noise trading for associated with 1 bet, because the sigma u would apply to all of the noise trades, let's say. And it turns out that the informed trader's trade in that model has the same kind of distribution, at least in the 1-period model. So it's proportional to CL, the size of the bet. And if you want to convert it into shares, you need to divide it by P. Okay, so it turns out also that the dollar trading profit of the informed trader winds up to be this invariant constant, C. It gives you a nice interpretation of this invariant constant. It's not only a constant that measures the price impact in dollars of executing a bet, but it measures the cost that maybe an asset manager incurs in the research and so forth that goes behind generating the bet if the asset managers are breaking even. And so there's $2,000 to generate the bet. So you can add adverse selection by adding a concept of resiliency to the model, this idea that the price The price, if it's moved by a noise trade away from its long-term equilibrium or fundamental value, the informed trading over time will gradually bring it back to its fundamental value. How fast does that happen? I used to have nice conversations with Fisher Black about this, where we would debate it hour after hour. But now we've got a model of it that I just ran out of time, so I don't get to tell you about it, but we can measure it. So let me, since I've run out of time, just quickly mention these other two models. One is a smooth trading model, and what it does is it says, look, all the traders are effectively the same, more like they are in today's market. It's much more symmetrical, where customers can provide liquidity to customers if they want to. And that means there's only one type of trader. And these traders think that they produce private signals, but they're maybe overconfident or relatively overconfident about their signals, in that they think that they're smarter than the other asset managers they compete with. And so that makes them trade with one another. And the way the execution of orders works is that they don't provide any instantaneous liquidity, and they don't demand any either. Instead, they demand liquidity over time. It's consistent with VWAP trading, or with spreading your orders out over time, and also with price impact, having what we call a temporary component, which is that in addition to the price, depending on how many shares you've bought in the past, which tells you what your inventory is today, the price depends on how fast you're buying the shares now. Faster you're buying the shares now, the higher the price is. That's the temporary price impact. When you stop buying the shares, the price impact goes away. So like in Robert Noe Mark's paper this morning, it could be that traders are executing orders kind of quickly and then withdrawing, and then the price goes back over some horizon. So the result here is that liquidity is offered over time, but not instantly. And traders trade gradually over time, and they trade gradually to a target inventory that is a function of their private information and other people's private information. It's basically their disagreement with the market over what the value of the asset is determines what their target inventory is. Okay, and it's different from my 85 paper, but I think it fixes this idea that traders demand instant liquidity. And finally, we have this flow trading agenda, and what it tries to do is take the batch auction idea and figure out how to implement it. And not only implement it for a single asset, but implement it for portfolios of assets. So we clear the market in batch auctions for demand functions for portfolios defined as linear combinations of assets. Turns out that can be set up as a quadratic programming problem, and it turns out we think we can solve it in a second for 1,000 stocks and for 1 million orders that are kind of randomly generated in the form of a simulation. So I will stop here and just say that I think my invariance research and also the smooth trading research and flow trading research are addressing a lot of the issues that came up in my 85 paper, and sort of bringing that paper more up to date and putting it, I hope, on the frontier of research today rather than the frontier of research in 1985. So thank you.
So Pete, we know that market microstructures vary, at least superficially, but profoundly across markets. And yet, there's some sense that the invariance model should apply across all markets. I wonder if you could try to explain that so that people understand how we can get regularities in the presence of so much variation in structure.
That's a good question. So you can look internationally, and you can see that invariance applies, could potentially, we think it would apply in different countries. The question is whether C would be, the cost of a bet would be different in different countries. And maybe the C, the cost of the bet, should be a function of, what are the salaries for finance professionals in different countries, or what are the costs of running the financial system in different countries. We also think that it might apply across time. So we do have a paper where we try to apply it to the 1929 crash. And we do find, consistent with what Larry said, that liquidity of the market in 1929 was phenomenally high. The price impact of the margin sales that created the 29 crash was much lower than what we would have gotten if something like that had happened in 87 or in 2008. Notwithstanding the observation that has also been made that market liquidity might be better today than it was, say, in the 1990s. So I think sometime between the 20s and the 90s, liquidity declined, and then it maybe has come back a little bit more recently, but maybe is not that much greater than it used to be. And then finally, invariance should apply across different types of assets. It should apply to fixed income markets, to futures markets, and to equity markets equally. And we've done a little bit of research on futures markets and bond markets, but not much. But the research that we've done makes us think that it does apply. So we think it's a kind of a universal phenomenon. And we think the C, that constant, should be, is in fact approximately constant across assets, stocks, bonds, futures in the United States. Internationally, it might vary. We're not quite sure because we haven't done a whole lot with it. But let me show you a picture. Can my slides go back up?
Yeah, can we put the slide deck back up?
Mm-hmm. Yeah.
Possible in the back.
There was a nice question earlier about what can we learn from international data. And here's our answer. This is data from South Korea, where they collect a lot of data and they have the identity of every trader on every order. If we apply the invariance hypothesis to South Korea, we look at what we call switching points here. So we look at every trader that trades equities in South Korea, and we ask, how long do you have to wait for the trader to switch directions from buying to selling or from selling to buying? So that's something that should unfold in business time. So if we can convert how long it takes to do that switch in business time into calendar time, it'll be a test of the invariance hypothesis. And the prediction of the invariance hypothesis is that the picture you're looking at, which looks at stocks that are the big, the middle, and the small size stocks in Korea, should have a slope of 2/3 because of these 2/3 powers that show up in this L formula. This actually estimated slope is 0.675. So this is an example of, and we didn't do any, this is a paper where we didn't do any data massaging. We just, this is kind of the first version of the estimate, out of our analysis of Korean data. So that's an example of this applying internationally. Many emerging markets have better data than we have in the United States and Europe because they collect data on the identities of traders to enforce, I think, prevent tax evasion and avoidance of foreign exchange controls and things like that. And so they have maybe a national monopoly or a carefully regulated setup that actually collects a lot of data. And so the data being better in foreign countries allows you to do, in some sense, better research. We're moving in that direction with the consolidated audit trail in the United States, but we've been moving in that direction very, very slowly.
Pete, how important is market microstructure?
Okay, well, that's a big question. The question is, how important is market microstructure? And there's a very narrow interpretation of market microstructure that says it's just a study of transactions data and bids and offers and quantities traded from a kind of mechanical perspective. But then there's what I think of as the big questions that market microstructure deals with, and that is, how do markets actually work? And what function do speculative markets actually perform? Speculative markets allow speculation and hedging to take place. That would be the way Keynes would have described it a long time ago. And so it's been a big theme in, I would say that the idea of trading in markets generating potential gains that we can measure and appreciate has been around since the foundation of economics. If you look at Adam Smith's book in 1776, The Wealth of Nations, a lot of it was built around the idea that they're gains from trade. And market microstructure ultimately is about trading, and ultimately is hopefully helping identify what these gains from trade are. Turns out it's a very complicated question because there are many externalities that are involved in markets and the way they run. So let me just mention a few. There are a whole bunch of them. But one of them is that some people use market prices as signals to tell them what to do. Like if a firm's stock price is really, really high, probably the CEO and the CFO are going to want to increase investment, right? But they're just using the market price as a signal, telling them to do that. A farmer might look at the price of corn, and if it's really high, he'll plant corn. If it's really the price of cotton is high, he'll plant cotton instead of corn. So they use prices as signals. But these signals are generated in some sense for free as far as the farmer is concerned or the CEO is concerned. So they're free riding on the signals generated by the market. But what makes the signals good? Well, what makes the signals good is that the information that's being generated by market participants, which are the asset management companies that institutional investors hire to manage their money. They do research. Research results in signals about the returns on investing in companies, but ultimately on what the prospects of these companies are. Competition among asset managers is therefore creating this value. But what pays for it is a combination of the fees that the customers, the asset managers pay, and the amounts, portions of that the asset managers spend on developing their models and developing their signals and trading on them. So who's paying, so ultimately it's the fees paid to the asset managers, and ultimately it's also the noise traders in the market willing to lose money that allow the traders who are generating good information to actually find it worthwhile to generate that good information and trade on it. So these are huge questions about the role of information in society, the role of information in economies, and if you define market microstructure very broadly to include not just markets for stocks and bonds and foreign exchange and commodities, but also real estate, maybe even labor, private equity, and so forth. The private equity markets would be governed by the same principles as anything else, and we think it's just a slower market in terms of business time, therefore less efficient in terms of the information that's being produced, therefore bigger rewards, per dollar invested in those kind of markets. All that's explained by the invariance idea, but we're talking about a huge fraction of GDP, in transaction costs. When you add them all up to include real estate commissions and all the price impact costs and fees and losses of noise traders and the equity and bond and foreign exchange and commodity markets, you're talking about multiple percentage points of GDP, probably more than the defense budget of most countries. So it's a huge first order effect. And we want these markets to work well. For these markets to work well, it turns out they need to be regulated. Another issue in market microstructure has to do with, why do we need regulation of financial markets? Well, we can look historically and see why we need it. New York Stock Exchange was founded under the buttonwood tree in the 1700s. And what it was, that they had the Buttonwood Agreement. That's a cartel agreement that would be per se illegal under any interpretation of the antitrust laws. And what they did is they regulated commissions. They said, we're going to trade, under the tree, which is defined in the New York Stock Exchange in that time. We're only going to let the members of our group trade with one another, and everybody else is going to be an outcast, and we're not going to do business with them. So they enforced it, with what we think of as non-competitive practices, and then charged fixed commissions, which is what we would think of as non-competitive prices. And that persisted for like 200 years, approximately, until the fixed commissions were declared illegal in the 1970s. That took regulation to make it illegal in the 1970s. It kind of persists until it's made illegal by the government. And incidentally, market microstructure research can tell us a little bit about, if you think through the objective function of the exchange, about what exchanges did and why they did it during that 200-year period. If you have fixed commissions, you can't have broker-dealers. Because what's a broker-dealer going to do? In their brokerage function, they're going to go to their customer and they're going to say, look, you've got to pay us this ridiculously high commission. And the customer is going to say, well, on your dealer function here, you better give us a really good price well inside the spread that kind of subtracts the commission out of what we're paying you for this transaction. So the exchanges realized that, and so they separated brokering and dealing. And so you had market makers or dealers on the exchange floor who were not allowed to have customers, and then you had the brokers who had customers but were not allowed to be dealers, and you had exchange auditors that came around and checked that the separation between brokers and dealers was actually kept intact. And that's consistent with the assumptions in my 85 paper, by the way, that you have the market makers who are separate from the informed trader and the noise traders. So that collapsed in the 70s when the fixed commissions were declared illegal. But then what do the dealer community do about that? Well, they set up dealer markets. And the way the dealer markets work is that customers essentially are not allowed to trade with other customers and clear their trades in any easy manner. You can pull out the trace data in corporate bonds to, a couple of years ago and ask how many customers traded directly with customers in trace. And the answer is, I think Larry knows the answer. Is it zero? But if it's not zero, it's close to zero. Because the dealer markets are set up to allow dealers to trade with customers and dealers to trade with dealers, but not customers to trade with customers. So the government came in and imposed settlements on NASDAQ and essentially changed the way the equity markets functioned, the way NASDAQ functioned in the late 1990s. The dealer market that had been set up in the 70s to capture the rents, that was partly captured through tick size, and you got to understand market microstructure to understand how the tick size allows the dealers to capture the rents. But we heard some about that in the panel discussion. That was set aside for equities in the late 1990s as the government kind of cracked down on the dealers having tick size that was too large. They mandated that the customers be allowed to trade with customers somewhere, and customers wanted an electronic interface. They didn't want to have to pick up the phone and call a NASDAQ dealer. So as soon as that mandate was implemented, the dealer market started declining, and trading over electronic order handling systems started to increase. The government also came in and regulated the markets by reducing the tick size. The exchanges left to themselves would have had a big tick size because it creates more rents for market makers. But the tick size got cut to a penny, and that changed the way trading occurred again. And I think there is where you see the decline in trading costs. In general, I didn't talk about it today, but trading costs have a kind of proportional component. You can think of it as a bid-ask spread component that might be, we estimated actually in our paper to be, for a typical stock, I've forgotten what it was, maybe 3, 4, 5 basis points for a typical stock that's not very liquid. And if it's pretty liquid, it's only a 1 basis point or 2 basis points. The market impact costs are much greater for institutional size orders, maybe 20 basis points, 30 basis points, 40 basis points, depending on how big the orders are and how liquid the stocks are, the L that I talked about. But it's, these are pretty huge numbers compared with the bid-ask spread costs. And the bid-ask spread costs, I think, of what have come down over the last 20 years and reduced trading costs somewhat. Market impact costs are still there. Guess what? Because adverse selection and private information is still there. So those are the market microstructure research helps us understand these markets and understand not only how they work from a perspective of an asset manager trading equities or other assets, but also from the perspective of a regulator trying to understand how can we help get these markets to function better. I think I used up all of my time on that.
It was incredibly well said. It was an historical lecture as well.
Okay.
Everyone, please join me in congratulating Pete for winning the Wharton-Jacobs Levy Prize. Thank you so much. Thanks, Pete.